Hi, everyone. Wanted to take a few minutes to cover a couple of topics on really a series. So, what I wanted to do is talk about the different types of debt, the metrics that are involved with different types of debt, and how that can create some distressed debt opportunities, which can create, some near-term windowed opportunities for investment. So, that's really the first topic. The next topic in the series will be around distressed debt opportunities, and then a follow-on set of topics that are related to debt and how that can create opportunities in this type of an environment where interest rates are changing. So I'll cover three topics on this video. But before I get into that, if you could please subscribe to the video on YouTube, the channel on YouTube, and then also subscribe to an investor series, 22 topics that I put out very regularly. And that'll also give you access to deals as they come online. And it'll be happening a lot here as we get into the last quarter, as we kind of wrap up the calendar and the tax year. There'll be significant opportunities that be coming online. So something to consider as we look to wrap up the year. So on this discussion, the first thing I wanted to cover off on are the three different types of debt that are I guess the primer on types of debt. First one is traditional bank loans. So you'll see up to 75% loan to value if the asset is worth 10 million. So that'd be about 7.5 million. 75% interest rates are lower, 5 to 7% on average is what you might be looking at, just in terms of a order of magnitude. Then you've got bridge loans. Bridge loans will go higher. They'll go up to 80% of the asset, for example, but there will be a slightly bigger band or a higher band of interest rates. So those will be 8 to 12%, typically in that range. And then you've got mezzanine financing. Let's say the bank has provided 12 million, you need to get up to 14, so that additional 2 might be covered through mezzanine financing, and that'll be 10 to 14% with stricter repayment types of schedules. So just keep that in perspective. What we typically look for are it's not the traditional 25-year, 30-year types of loans. There's agency debt and other types of debt that we typically use for these types of assets. And what that does is it's usually 5 to 10 years in terms of the payment schedule, but the amortization is on a 30-year schedule. So that's important here. In a second, I'll cover off on that in terms of how that impacts the repayment structure, or the repayment schedule rather. So 2 or 3 metrics to cover: the debt structures and the impact on how that will have an effect on the investment strategies. Loan to value ratio, looking at that conservatively, you'd be at around 60%. That means the value of the asset, if it's a $10 million asset, would need to drop by 4 million up to where it's 6 million. And that's where the bank starts to feel like, can we recover all of what we've lent out? Or when does that become problematic or potentially risky for the bank? So that's conservative, because you've got about, think of it, $4 million of excess equity, which covers the bank's risk. And so loan to value is important from that vantage point. The other thing to keep in mind is, if you've got an aggressive loan to value, let's say 85%, the asset is a $10 million asset and the bank has lent out 8.5 million. Well, if the value fluctuates by 2 million and drops to 8 million, well, now you're sort of upside down, and you've created a default risk to the lender, to where that becomes problematic. So keep that in perspective. I'll talk about that towards the tail end of this video. The other metric, which I think is important to mention here, is also the second metric, which is the debt service coverage ratio. Typically, banks will look for 1.25 to 1.5. What that means is, for every $1 of debt repayment, lenders will look for 1.25 of generated cash flow for every dollar that gets paid back. So it's 1.25 to 1.5. So 1.25 or $1.50 for every dollar of loans that are paid back in terms of loan repayments. So 1.25, 1.5 is about the industry average. And then we've got the third piece, which is interest rates and amortization. I think you all are very familiar with that. All that really does is, on a 30-year amortization schedule, you've got a longer window, slightly lower cash payment. But if you're aggressive on the debt repayment, certainly can create equity sooner, but there's more pressure on cash flow if you're on a 15-year schedule. So just keep that in perspective. Amortization can be helpful in terms of realizing value, but it produces more strain on the potential cash flow, and you've just got to make sure that that's underwritten in when you get into these types of asset classes. So this is the lead-in topic, the third piece. How does this create opportunities in distressed assets? That's really the main point, and that'll be the next topic, and potentially the one after that as well on this YouTube series. So, debt in distress situations, how does that happen in terms of excess leverage and boom periods, which is what we saw over the last, 2020, 2021, 2022 period? The appeal was to be able to leverage up and go with high, 85%, 80% loan to value, and also buy a lot of floating rate debt without interest rate caps. And so the Fed raised interest rates over the last year or 2 years. We all know what happened there. And so what was a 5%, 4% interest rate might have gone to 7%, 8% in some cases. And so what that'll do is you might add 20, 30% to your cash flow, and that will quickly bring an asset upside down. So floating rate debt, not a great idea in a rising rate in interest rate environment. Nobody could have really predicted the pandemic and everything else that happened around that, and then the Federal Reserve raising interest rates. So that creates some natural strain on the cash flow side. That's one thing. And then the other piece is, as you see certain asset classes like office spaces, for example, occupancies come down and the value then comes down, or cap rates go in the wrong direction, and you end up in a situation where the leverage is now upside down and the asset is worth worth less than what the loan might be. So keep that in perspective. Some of this excess leverage can create some opportunities. So a lot of people are getting out of bad debt, and that's creating an opportunity for folks like us to come in and be able to purchase those assets at a discount and with more equity that's realizable at a lowered interest rate. And in some cases, we're able to negotiate debt down because banks love and lenders love these asset classes, just because of the fact that you've got hundreds of units and there's many different components that are paying in the rental cash flow. So they see them as relatively more stable assets from a lending perspective. The other thing that I mentioned, the interest rate hikes, those can certainly create a lot of pressure on floating interest rate. Good idea to buy, the interest rate caps. Now, those were extra expenses that a lot of folks might have avoided, and that very thing 2, 3 years ago, when they've avoided those interest rate caps, those would then produce these opportunities for us to come in and purchase those assets because they're not performing as they might have as they might have planned for with the underwriting that folks might have done a little bit too aggressively. So, that's the second component. The third one is obviously missed debt payments. If the cash flow goes upside down, interest rates go up, start missing debt payments, that's an opportunity to come in and be able to offer equity, which in a lot of ways is like a capital call, but it's a third party producing or injecting the capital. And that can create some very, very fast return or highly aggressive returns on very little equity. You might get a very, very strong equity multiple because it is a distressed asset, just needs a little bit of an infusion of cash to be able to take care of the debt restructuring as it's happening. We restructure the debt, infuse the capital to be able to take care of the operating expenses, manage the cash flow, manage occupancy at the same time, and then get the asset going on its way. So that's another subtype that we're seeing, not just refinance opportunities and purchase opportunities, but some of these distressed assets as well. So went on a little longer than I wanted, just a 9-10 minute video covering all these three topics and all the things that I think are important considerations: debt service coverage ratio, the rising interest rate, the ability to meet cash flow, and then at the same time looking at different types of different types of debt and opportunities that might relate to purchase asset classes directly or refinance them as well. And then also look at some of these distressed asset classes. So just a few things to keep in perspective. Second video, we'll go into more detail on some of these restructured or debt restructuring opportunities. Like I say, please feel free to shoot me an email or comment below on any questions you may have. And I look forward to talking or communicating with you all on the second topic as I get that ready in the next week or so. Have a great weekend. Thank you.